I'm Jill Schlesinger, editor-at-large.
I'm Jack Otter, executive editor.
We're here to talk about the dueling debt plans and what they mean to you. Jack, we got two plans. What's going to happen?
Well, first of all, I got to go on a rant. You would think the two plans are now about that close apart. Can't these guys just split the difference and get on with life? It's really so political, and nobody seems to be thinking about what the actual consequences are, what the real-world implications of their actions are. It's just, Obama wants a blank check, and the Republicans are evil, and I wish they would just solve this problem.
And it does seem
like... You and
like
I could do it in a second.
That's right, like that. It's a matter of timing, because it's really about when the debt ceiling rises, but the implications, as you say, are tremendous. I'm starting to think that only with a stock market plunge will these banana heads actually get together and create a deal. But it's scary to think that we need 1,000 points down on the Dow to get them to act.
Well, I really hope that happens, just to get them into line, because that's actually the best thing that could happen. What scares me is that the bond market is going to blow up. And with the stock market, we saw this back in October of '08 during the crash. The market fell 800 points in one day and bounced back up 800 points the next day. But if the bond market blows up, I don't think we're going to see quick repair. You could see mortgage rates going up. 4.5% mortgage rate could be a thing of the past, never to be seen again. If we get this downgrade, it could mean that portfolio managers have to sell because they're required to hold some AAA bonds. If U.S. Treasuries are no longer AAA, they got to look elsewhere.
So this actually calls into question a bigger issue for the individual investor. Should I do anything different? I don't think so. I think that if you've got a well-diversified portfolio, that will really see you through. We've talked about this on MoneyWatch a zillion times, which is you shouldn't have long-dated bonds anyway. It's not a great environment for that. If you were to do anything right now, the one piece of information that I would send out to everybody is I would have a little extra cash floating around in my portfolio just in case something bad happens. Anything else you think that people should do?
Well, we're always seeing the praises of index funds. We tell everybody to always index. I'm going to go against that advice just a little bit. I'm not sure that you want to just own the bond index. I wouldn't sell it all together, but I would want part of my portfolio to be in an actively managed fund. Bill Gross has been betting against Treasury bonds. He was completely wrong. Well, now you got to think he might just be right, and if not, why not hedge it that way by having an active manager who can choose which bonds he wants. So if he thinks U.S. Treasuries, for instance, are scary, he gets away from them. You can't do that with an index fund.
But if you want to know what to do with your portfolio, we've got lots of advice on MoneyWatch.com. Thanks for watching.